You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block with your host, Mark Longo from TheOptionsInsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, everybody, welcome back to the Option Block. We are, of course, your bi-weekly source for all things options related. My name is Mark Longo from theoptionsinsider.com, as well as from this here Options Insider Radio Network. And if you're wondering to yourself, you're saying, gee, I love all the shows you guys do, but I wish there was a mobile app for that. Well, you are in luck, gentle listener, because there is an app for that. The Options Insider mobile app is now available on the App Store of your choosing. So you can find it on the Google Play App Store. You can find it on, of course, the iTunes App Store. We even made a version for you Amazon lovers out there for the Kindle Fire devices in your life. So whatever device you're working on, I guess we don't have BlackBerry, but maybe we'll put one of those together eventually. But pretty much any device you're rocking these days, we've got an app for that. So check it out in the App Store of your choosing. Search for Options Insider Radio Network. I guarantee you we're the only one. And you can download it there. You can, of course, stream every episode of this program as well as every other program on our network. You can download them for offline listening in the car or on a plane or train or anywhere you listen to our fine programs. And you can even write to us with all your great comments and questions and feedback. A lot of great stuff for you guys to check out in the Options Insider Radio Network app. I think you're going to like it. All right, and joining me on the truncated all-star panel today, unfortunately, the Viceroy has come down with whatever is cutting a swath through Chicago these days, so he won't be able to join us. But nonetheless, we are joined by none other than the Rock Lobster himself, good old Andrew Giovinazzi from OptionPit.com. Mr. G, welcome back to the program, sir.
Pleasure to be here. It's a pleasure as always. We have gobs of snow in Maine. All I can say is gobs. The lobsters actually have even jumped out of the water and taken up skiing on the coast.
That's their winter pastime, even for the lobsters up there. Amazing.
They are. They just kind of, they sort of stand on their claws and just slide down the hill. It's quite impressive to watch, actually.
That would be something to see. I missed the great lobster slalom races last time I was up in Maine, so I'll have to check it out next time, that's for sure.
Exactly. I think maybe next year, if we get this much snow, we'll have an Olympic event for all those lobsters that hop out of the pot.
You're getting all of our snow that is melting down here today, because finally in Chicago it is above 40 degrees, so all that snow is going the way of the dodo, which is kind of nice, because we had a wee bit too much of it. We're not like you Mainers. We don't, there are no hills here, so there's no real good use case for the snow. It just piles up and is annoying.
No, there's not. I lived in Chicago for 6 years. It really actually just gets in the way mostly.
It does. I'm from New England as well, so I'm used to a landscape with some character, some hills and some big mountains and stuff. And out here in the Midwest, not so much of that. So pretty much just flat space that's pretty much open and white. Unless you're downtown like us, then of course it's flat space where the snow is dirty and brown, which is also its own joy, I suppose.
That is not painting the Norman Rockwell-esque picture that your listeners come to enjoy on the option block.
Yes, they tune into the option block for our wholesome imagery of home and hearth that we like to convey here on the show.
Exactly.
If you're tuning in for that, listeners, I think you're missing out on some other programs, maybe on NPR somewhere where they can convey that to you, This American Life or something, Prairie Home Companion, something along those lines.
Whatever schlock that they sell over there. We don't do that here.
Speaking of the prairie, we'll be joined a little bit later by good old Uncle Mike Tusaw, who is in the process of jumping on as we speak. So for now, it's time to keep on rolling into our first segment, the trading block.
The trading block.
All right, everybody, you know what those bells and those that chorus of yells means. It means it's time for the trading block, the portion of the program where we break down the day's worth of activity, the day that was from a market perspective. And it was yet another day where people are kind of shrugging off the macro concerns, kind of shrugging off everything else and saying, you know what, this market must march forward and it must march northward. And that's pretty much the only direction it can go. We were up yet again another 0.5% or so, actually 0.6 of a percentage point or about 11 handles in the S&P today. Dow up about the same percent. In fact, all three pretty much lockstep. Q's also up about 0.5 percentage point as well. So it was quite the rollicking day on the old street going into the end of the week here. VIX cash tricking off a little bit, down about a little over 4%. I know that drives you crazy whenever I use percentages, Andrew, for the VIX. So I like to mix it in there every now and then. Closing today at 14.82. So we're kind of in the midst of that region we've been in of late, where we were dancing with the low 20s, and then, of course, it kind of underperformed to the upside. Then it kind of aggressively came back down to the mid-teen or so range. It got a little bit lower, then it kind of bounced a little bit higher. Now we're kind of just hovering back around that 15 handle. Oh, excuse me, it just ticked down to 14.81. So breaking news here on the option block. But Andrew, let's start there as we are wont to do here on the old program. It's been a week actually since we've done the old show, so a lot to look back on. What's your take on what's been cooking here in the vol land since last we spoke?
I think the volatility is probably fairly priced, given our propensity for 1% intraday moves. I think we've had a 1% intraday move. I don't know, 10 out of the last 15 days or something like that. It feels like it anyway. So I think your 15 VIX is about fair. Emerging markets, revolution in Kiev, nobody cares. Really hasn't been the balance of payments, destruction of all the currencies we've seen. Most of those markets have bounced back. So, I think the market is tentatively making highs. The thing I think most interesting is we've all pretty much everybody, I think now, all the economic data from January is all going to be low and bad because of the weather. And if anybody tried to drive around when you couldn't go to work, just basically take 2 weeks out of that month because nobody did anything. So that data would be, I think the market's discounting that now, which is why we have these kind of funky rallies on news. They're like, oh, the data was bad, but it really wasn't that bad because nobody could go to work. And I would say, though, just as a little aside, how do you make money in the stock market? You got to buy stocks when nobody wants them. I'm just looking at the QQQ today, and lo and behold, it's back above the 90 handle, although only 5 cents. But you know what you could have bought those Qs for many, many moons ago in 2002. Guess.
$31.
Huh?
$31.
Lower, $21.
I was close.
$21. So that was pretty much the bottom, and obviously 2008 I think they got down to like 30 something. But that's a 4 times your investment plus. So ultimately, because we're going to do our when I do my little pitch at the end here for our March 8th, our webinar about selling puts in a junky market, I think once a decade you got to be a buyer. So it's funny to see that this instrument getting back up to these levels. And what's funny is, what is the average PE ratio of, let's say, Microsoft, Intel, Google, Apple, maybe Qualcomm, the top 5 stocks that make up the Qs? I think that the PE ratio is only about like 14, 15 maybe. I mean, Google's the star there with probably a 30 PE because they're going to take over the world. But what I find funny is like most of the market value in that index is still at a relatively, I think even at a relatively cheap market PE to even, to the S&P 500. So it's 90, but the all-time high was almost 120, and I'm not going to really be surprised if we see that in the next few years. Total recovery from the tech crash of 2000. It's like any stock market crash. It takes about 12, 13 years to get back to that level again, but it feels like it's on its way.
You diehard bull, you.
I think that technology. I will just say that I think technology has a long way to go. There are some areas, obviously, that are starting to get pretty expensive, the social media stuff. And, Facebook is a $70 stock now, traded 70. So they're paying $19 billion for that other company. So there's that part of the social media market obviously just got valued because of what Facebook paid for this company. But the kind of vanilla technology stocks are not that expensive. So could that index go higher? It wouldn't surprise me too much.
Speaking of diehard bulls here on the old show, we are now joined. Listeners may have recognized his voice by good old Uncle Mike Tusaw from RCM Wealth Advisors. Uncle Mike, welcome back to the show, sir.
Always a pleasure to be here. Hopefully I don't have to boat my way out here with all the rain and flooding we're getting today.
Yeah, it's quite the interesting day. I was watching large chunks of ice swirl down the Chicago River earlier today. Kind of an interesting sight. Don't see that too often. But yes, Uncle Mike, in all the maelstrom of activity that caught your eye today, what was top of mind for you here?
Oh, a bunch of things, actually. Yesterday, it turns out that this is a very schizophrenic market, it feels like, the last couple days, and that everybody wanted to sell yesterday. Everybody wants to buy today. And for a brief moment yesterday, I got to say one of my favorite things to say, at least with SPY. Never in the history of SPY has there been a better time to sell than yesterday for about 30 seconds.
Yeah, I didn't know what to say to that. But it's hard even to write calls against some things. It's just, I hate to say, it's just easier to be long. It's too much work to sell calls.
Oh, it is. It's the hassle of rolling up calls. What a pain in the neck that is.
I know. It is kind of hassle city, but it's a good problem. I think that the trend that is most interesting to me right now is the trend for gold. We finally got starting to get a little peel back in the treasuries from possible higher interest rates, but that hasn't really stopped gold. I don't think the bonds are really reacting much yet. I don't think anywhere near, obviously not near back to the levels they were at the beginning of the year, but gold seems, it took a breather after about 8 straight days of rallying, and it looks like it's trying to restart its march again. So very interesting for me.
Yeah, gold's definitely been on quite the tear to the upside this year. That's for sure. I think we opened the year, I'm looking at GLD. We opened the year, the year of the open was at 119. Now we're already up to 127.5, or a little bit above that. And, we've gotten above some key resistance levels. And so, I don't know, I think that over the last couple of days, it's kind of eased out a little bit. But when it went down yesterday, it sure went up today. That's for sure.
Yeah, no real. I was looking. I thought we had some good follow through in some of the bonds, at least from like an interest rate. But it just seems like people want to buy gold again. I don't really know what the reason is. Maybe it's the Chinese or some huge buyer, but it's kind of got that, it has that steady pace of, some large buyer just keeps wanting it. And I don't think they're done yet.
Well, I mean, the reason you buy gold is the same reason people always buy gold. It's shiny. But with that, silver's also been going on a tear this year, even more so than gold. I think silver earlier in the year you could have got in the 18s and it passed the 21 level today again. It had a pullback yesterday, but silver's also just been on a tear so far this year.
Andrew, getting back to what you were talking about before with the good old FB, the Facebook, they were probably the biggest news of the day. And just getting back, you're right. It is starting to smell. People always say this, and they're always calling tops. And I'm not saying I'm calling a top or anything, but it certainly is starting to smell a little bit like those go-go late 90s days when, a name like Facebook could come along and just essentially spend $19 billion for an app. Granted, it's an app that has a lot of users, 400 million, I think, something along those lines. And
that's a lot.
And on a day that they could spend $19 billion and the stock closes up 1.5 handles. It's just nuts. Apparently the market's smiling on this deal, saying that's a good valuation per user for that trade. Putting aside all the other things we always talk about social media, about the fickle nature of the audience and how can you maintain these networks and that sort of thing. But it's just interesting to see how much they can throw around. And hey, they're playing the old tech bubble game of throw that stock around like it's nothing. I think the deal was it like $4+ billion in cash, and I think like $12+ billion or so in stock, and then some other stuff to acquire over
some warrants, right?
Yeah, accrue over time if the people stayed for X number of years. So yeah, throwing that stock around like it has some value because suddenly it does. It's not $19 anymore. But
no,
yeah, I'm getting that whiff, that hint of hey, we got stock. Let's just buy some stuff. That we saw a lot of towards the end of the .com days. Mr. Tusaw, any of your clients calling you up today saying, hey, why am I not in that big Facebook? Are they loving that one?
Well, in the strategic night portfolio, a lot of my clients are in Facebook. At last I looked, so definitely in our equity portfolio that George is working for us for a lot of our clients. We are. So haven't had a call saying why I'm not in it because a lot of people are in it.
Strategic night, I like that. So you have some strategy, and then you go to sleep at night. Is that how it works, or is it the knight who slays the dragon type of night?
Kind of that type of night.
Or is it the opposite of the Dark Knight portfolio where all your short picks are in it? You got the where you wear a rubber suit and make stock picks.
Oh, the
rubber suit. You're only going to buy
portfolio.
stocks. We're going to wear a rubber suit like Batman with the Dark Knight portfolio.
Definitely.
That'd be your version of the Sin portfolio. It'd be all alcohol and gaming stocks and stuff like that, and it would all be nothing but short premium. That's the Dark Knight portfolio.
I remember the Syndex.
Yeah. So you'd be blasting out straddles on a bunch of Sin type names. That would be the Dark Knight portfolio, I think.
There you go.
Short gamma all day long for the Dark Knight portfolio.
You have to load up on that one in a recession, though.
Yeah,
because everybody's going out and they're buying beer and going gambling and anything they can do to take their mind off of their current woe.
I knew there was something I was overlooking. And speaking of all this social media bubble and kerfuffle, and just, Web 2.0 type apps that have made a splash of late, Groupon reporting today in the after hours. And for those of you playing the home game, it is indeed February 20th. So we're looking here at Groupon closing at $10.29. That 10 straddle going out for about $1.45 or so. And we're seeing it right now in the after hours, taking a little bit on the chin, down about 60 cents. Or so. So we'll see how that holds out. So far, looks like the premium sellers are the winner, but again, it is very early in that dance. We shall see how that plays out over time. We saw with Google before, all over the place. It is typical for a name right in the immediate after hours to be all over the place. So we'll see what goes on out here as the show progresses. Mr. Andrew, you guys doing anything out there in Groupon these days? I know once in a while you delve into those waters.
Right. We've actually avoided it. It's like a lot of those social media, they were interesting when they got super cheap, and now they're, now I'd say that I don't think they're when they were trading below the cash they had in the bank, I think they were interesting, and now they're stocks with some growth potential, and like anything else. So the Groupon's kind of the same way. So we've sort of avoided it, and just see how they survive. I just think they're in a tough racket with tough competition. But it does seem to me that they do what they do better than the stocks, like Amazon tries to do everything with daily deals, Amazon basically tries to do everything that there is on the web to do. But as far as Groupon goes, we haven't looked at it just because it's become mostly uninteresting at this level.
Yeah, I'm waiting for Amazon to launch their Amazon Options Outsider. And then our lawyers will see to them promptly. But we used to mock Grigas for getting in around that 5 handle, I believe, and he's looking like the genius now. In hindsight, hopefully he's held it the whole way and been buying more the whole way up to pay for that pool and whatnot he's got going on over there. The other big name crossing the 5 handle today, your other big holding, I know, in the personal Giovinazzi portfolio, of course, Zynga. Are you back on the Zynga train full? I know you were waiting before. You were kind of playing the wait-and-see game. You were waiting to see if they really called you back into the risk reversal. I know you like to wait.
I haven't seen a decent one yet. I've been looking for a couple of other stocks. But again, if I probably was long it still from there, it would be fine. But I basically just sold puts. It ended up being okay. Every once in a while I had a straddle that actually performed pretty good. So I think it's at $5. It's interesting. It's trading now for probably twice the cash they have in the bank as opposed to at the cash they have in the bank. But these little social gaming companies, which keep trying to extort my son for, $1 to upgrade. He's like, please give me $1 so I can upgrade my whatever. And I know you cannot. So Again, interesting. The company is interesting at this level, not as interesting until they start making some dollars again, and then maybe they become interesting again.
Yeah, I was looking while we're talking. I know, like I said, you're a fan of the bullish risk reversal out there. Not looking at things, not looking too attractive right now out there at these levels. We'll have to, maybe I'll dive in a little bit further. Part of that is just writing anything on the 5 handle in Zynga really scares the hell out of me. So
no kidding.
You got to roll.
I don't want to go back to 2.5.
Yeah, 2.5, 3 handle. I can trade my way out of that, no problem. But 5 handle,
it's a long way down from 5.
Exactly. You're looking down a perilous slope when you get up to 5.
It becomes real money all of a sudden.
All right, and that is going to do it for the old trading block. And now we're going to keep on rolling right on into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, that tune means it's time once again for the funky part of the show. It is indeed the Odd Block. The portion of the program where we break down the intriguing, the bizarre, sometimes outright weird paper we're seeing lighten up the old tape here in the options market. Going to kick things off with a newcomer to the Odd Block today. This is Veeco Instruments Inc., ticker symbol VECO, closing today down about 1% to $40.21. This is the name that does about 500 contracts a day, doing about 8,000 today. So about 16x what they normally do here. So a lot of activity. But one of the reasons we wanted to highlight and start off with VECO today is it's kind of a little bit of a different spin on what we normally see here in the Odd Block, which is people loading up on upside. Now we're seeing the other side of that coin, someone loading up on some near-term downside. We saw someone coming in today and just gobbling up the Feb 38 puts. These are, as we said, these are about 2+ handles out of the money. These have not too long to go. These expire on Friday, of course, or with today factored in. They really have one more day left. So it's a daily option at that point. Someone coming in, loading up on 5,000 of these VECO Feb 38s for about a nickel to a dime. So lifting the offer on some of them because they were at a dime for a while. We saw pretty much decent blocks going up for most of this trade. And this there is some open interest on here, so 3,000 open. So there could be some closing, but it's 5,000 going up, so it's well more than the open interest. So someone's opening here somewhere, at least a few thousand contracts on a strike, a couple handles out of the money with 1 day to go and paying a dime to do it. So that makes us scratch our chins and say perhaps there could be something cooking to the downside here in VECO, something perhaps by the time you even hear this tomorrow could be cooking. Was that your take as well, Senior Lobster?
Yeah, I mean, they had like an earnings announcement, so that's why I figured some of that might be closing, but why buy the extra 2,000? That's what I.
Yeah, you don't flip the script unless you're looking at something pretty nasty.
Yeah, so I mean, is somebody going to downgrade him tomorrow? So I couldn't quite figure out what the verb, maybe because somebody had to accommodate something and then they had to find somebody to accommodate the accommodation. I don't know, but I just thought it was that kind of paper looked a little odd to me, right? Odd why you'd be buying more than the open interest. So that maybe something else comes out. Who knows? But strange purchase nonetheless. 2,000 contracts for a nickel is, once you get up to that number, it's not nothing. It's just like throwing 10 grand away. So,
yeah, it's not insignificant. I mean, it's not millions of dollars, but it's something you will notice if you're
like you wouldn't just give somebody $10,000 because you liked them. Like, okay, here, okay, whatever, I'll give you 10,000. So
5,000 maybe, but not 10,000.
Go get some
exactly.
coffee.
5 grand maybe, but not 10,000. So I find that let's just call it odd and unusual. Unusual worthy.
Hence the odd block. Listeners, pay attention to that one when you listen into this tomorrow, because there might be some news coming out about that one right there. Who knows? We might be trading well through the 38 handle by the time you listen to this tomorrow, in which case you'll say those guys are geniuses. They really spotted it. And if it's moving unched, then just blame Andrew. That's what I like to do. All right. Next up on the old odd block, a returning favorite of ours. I believe Andrew has referred to this one many times in the past as being predictably crappy. Let's see how much predictability there is in this crappiness. Today, I am talking about VXX. This is, of course, the short-term VIX ETN, and this is the name that does some size volume. Like I said before, it's some days the number one exchange-traded product by volume out there, and the options are no slouch either, averaging about 300,000 contracts a day. So that's some size paper, particularly compared to what we usually talk about here, 300 contracts or so in the odd block. And doing about 300,000 again today. So it wasn't the overall size that caught our eye so much as it was the size of one crazy, funky trade. We are talking about Jan, so we're rolling on all the way out to Jan 2015. And we saw some pretty good size going up in the Jan 30-40 put spread. In particular, this was a 1x2. So they are, of course, buying 1, selling 2. It looks like it went up for a net of $1.64. They did it 17,200 by 34,400 times. So some serious size here in this crazy 1x2. Of course, buying 1 of the 40s, selling 2 of the 30 puts to finance that trade. Some open interest on both of these strikes, 25,000 by nearly 40,000, 37,000. So it could be closing as well. I mean, it is some size open interest on there. We'll have to, of course, play the wait and see game tomorrow to see exactly what it is. What was your take on this one here, Andrew? You think it's closing? I think they're piling in.
Well, you know what? I think, and more volume went up. Toward the end of the day, another 5,000 contracts. So I think they're just trying to pile on and do it more. So at this point, the volume today was over the open interest. So what I find interesting, I guess I should say, is the structure of this trade, like how it pays out. So they're putting it on for a debit. So volatility really flies, I guess they could buy in the short leg of the trade at some point in time. But with the way VXX decays, it in a year it's probably in the 20 handle by then. If just say VIX will go up and down and do whatever it's going to do, but if VIX ends up at 15, 16 handle next year, which since it's mean reverting, it has a good chance to do that. VXX will be like 20 or 25. Then all of a sudden you're 1x2. You don't make any money. So I'm assuming they're putting this on to unwind on the next big volatility pop. That's sort of how I see this trade. I think it's really the only way it works because the way they set it up, they're going to undershoot the break even on the downside with decay in VXX.
Yeah, we talked about VXX many times in the past about how it performs and how that roll really crushes it. On any given month, I've seen studies between 5 and 14% of how much it gives up to that roll. Of course, that depends on the term structure out there in the VIX future. So looking out a year, that's an aggressive amount of time to be putting on this 1x2. You're right. All other things hold constant with VXX. It certainly should be a wee bit lower. So that 1x2 could indeed come back to bite you. If you're planning to hold this near to expiration, then I think this trade's going to look a lot different by the time that rolls around.
I think so. But, maybe that person with the 60,000 contracts, he knows something I don't know, which is entirely possible. Many people do. So we'll see how it works out. But it's definitely worthwhile. There's a lot of stuff written about these vol products. So, I think somebody gets like a bug or an idea in their mind and they're like, okay, well, this is how I'm going to trade it because I know how this is going to work. And, we'll see what comes to fruition on all that.
All right, next up here on the old odd block, we have EcoLab Inc., ticker symbol ECL, closing today $101.87, pretty much unched on the day. They do, about 200 plus contracts a day, doing about 5,000 today. Not exactly surprising given the fact that they have earnings before the open tomorrow. So if you would get some paper on before their announcement, you had to do it today. And what we saw again was seems like puts are the trade du jour today for the most part. Of course, we saw it in VIX. We saw it in VXX. We saw it in some of the other names, and now we're seeing it here again in EcoLab as well. We saw and then longer term puts here again as well. We're rolling on out to April this time for the April 195 put spread. This time no ratio, just straight up 1-to-1. That went up about $1.15 today. ADV today, as usually in this, like I said, in this name, not that much, couple hundred contracts. But what was interesting is when we profiled it, we had gone up already. The total ADV of the day's worth about 250 contracts, and by the end of the day, it had gone up about 10x that. So about 2,000 contracts going up on this April par 95 put spread against open interest, just a couple hundred contracts on both strikes. So this is all open in paper. And again, looks like someone prepping for some not so near-term downside here in EcoLab. This is not an earnings play. Obviously, they're rolling out well past this earnings cycle.
Felt like these kind of should go up as spreads. When I looked at it, it looked like a lot of spread. Trading initially, they traded for about $1.15. And it looked like from the way the paper kind of set up at the beginning, they were trying to sell these put spreads on the opening. But there was some two-way paper. But for the most part, it looked like they were trying to sell this put spread, sort of I guess a way to be long at $100 or something like that. And then the size was kind of medium size, like 200 contracts was the size we posted here. But there was 80s, 70s, 50s, 30s. Real type of bizarre, almost felt like a newsletter type trade. So again, I'm thinking that it was a put spread seller trying to, basically take the stock at a lower level and, with some protection. Could be wrong, but that's the way at least the prices look like they, the way the options sort of traded. I mean, the volatility in April is 19. So I'm going to assume there wasn't a whole lot of option buying there with earnings tomorrow on this stuff. So that's the only way I could see that works, right? That most of the volume was up. And to be honest, I think it's pretty cheap volatility for this thing for that term of a hold.
All right, rolling on out to our final name here in the old odd block, a name we've talked about once or twice here on the show in the past. This is EAM, of course, the Emerging Markets Index ETF, ticker symbol EEM, closing today $39 and some change, pretty much roughly unched on the day. And this is the name that does some paper, doing about 375,000 contracts a day. As you might imagine, emerging markets on everyone's minds these days. This one's lighting up the old tape, doing about 2x that, 700,000 contracts today. So EAM taking one of the crowns today for volume. That's some size paper. When you're doing 2x VXX, you're doing some paper. And this one, what we saw today, yet again, the narrative of the day, put spreads. Go figure. We saw the June, this one out to June. So yeah, we're seeing put spreads and longer term is kind of the theme of the odd block, it seems like today. And here we are rolling out to June at this point. We saw the June 37.5, 32.5 put spread going up. Get ready for this one, listeners. A whopping 162,000 times. So pretty much half of that total volume today, a full ADV's worth of volume going up in this one just redonkulous, that's a technical term, put spread here. There is some paper open on the June 38 puts, about 122,000. So this could be tied to that. Of course, they only did about 12,000 on that strike, so that wasn't like they were closing on that strike indirectly. But still interesting and ridiculously sizable paper going up here on these strikes. Open interest on both of these strikes is essentially negligible, especially compared to this number, about a couple thousand each. So this is all open in paper here on both strikes. Senior Andrew, what's your take here on this size put spread going up in EAM?
I think it was Tucson. It was the Dark Knight Fund whacking puts out, thinking the emerging markets were going to jump. I guess I just broke myself up and nobody else on that one.
That was very good. I was laughing so hard I had to mute myself, sir.
Yeah. What's funny is there was some sold sales going up. There was a little bit of the price reporting was not, I would say, clean on all of it. Open reporting sequence, sold last, that kind of junkola. But they basically, all the pricing traded on or near the bid. So they were either doing the put stupid of the century, selling put, or taking in a nice dollar credit to sell that put spread, which, would be not a bad return for the 3-month period that you're holding. On the risk you've got to take there on that spread, about 20% return for 3 months on the $5 spread, something like that. You're going to risk $4 to make one, so that's a 25% return. I don't think it's a bad looking trade if it's just a straight up put spread sale. Implied volatility is still, pretty juicy. So, that's actually almost out of, like I said, out of the Tucson playbook where, you want to own something, you sell some put spreads lower, and if you end up taking the stock, you're protected. So that's one of the more sizable trades that looks like they're kind of fading this whole emerging markets panic and putting a sale somewhere near the bottom of the pricing. So.
Yep, the Dark Knight portfolio getting a little timely, a little aggressive, saying this whole emerging markets furor a bit overdone, and we're going to put our size where our mouth is here and blast out 162,000 EAM puts, because that's the kind of way you roll, Tucson. I know it. You may play it down here on the show, but you sling some size when you want to get into it.
I mean, he almost had to get on his tractor and drag all those contracts to the to the booth. It's a lot.
I had to drag him to the general store here. Ma Bailey would make good for him.
All right, and that is going to do it, listeners, for the old odd block. And as I mentioned at the top of the show, the Viceroy could not join us today, so there will be no express block. But never fear, he will join us virtually in my favorite segment of the show. Don't tell these guys, but this is really my favorite part of the show, because once a week we get to break open the mailbag and have you guys join us here on the old All-Star panel. Yes, it's time once again for the mail block.
Now it's time to empty the mailbag and see what our listeners have to say. It's the mail block.
All right, listeners, welcome to the mail block. Again, this is the portion of the show where you guys get your chance to join us here on the old All-Star panel. And as I mentioned, we're going to have a virtual contribution from Mr. Alex. He has no voice, but doesn't mean he can't type. And so he said he wanted to actually revise his answer to a listener mail question we had last week. It was a question from a user went by the handle Snowbird. And you may remember, as listeners, he wrote in about gamma scalping and why it's hard for retail to really do that, and he gave some examples. I would read the whole thing, but it's pretty long, his question, so if you want to hear the whole question and Alex's first response, go check out last week's episode. But Alex he said at the time risk wasn't going to be there, and it was kind of hard for the firm to really update stuff in the after hours to reflect the new delta position of the after hour stock, even though the options were closed, and how it wasn't really that feasible for them to do. He amended that today to say this. On earnings event days, the risk group does stay around until 5:30 to 6 if there are positions affected by the earnings in the customer base. So the risk department would be around if a customer wanted to offset the option position with stock. So there you go, Snowbird. If you did want to adjust those deltas and have it be reflected in your account, you could call up risk in the after hours, and they would be around at least for the first few hours. The challenge is that the position could be offset with stock, and the requirement could be adjusted by risk. However, there would still be $1 borrowed to carry the position. If the customer had a portfolio margin account, the stock offset would be recognized, but that doesn't alter the issue of needing enough money to finance the stock. A black and white example could be thought of as buying a $100 stock on margin and buying a 95 strike put. The requirement is reduced by the put purchase, but you still have to carry on the borrowed amount. So what he's saying there essentially is just that, the risk would be around, so you could call and adjust and have it. But what we kind of came to after that conclusion last week was that you need to have enough capital still lying around in your account to really have that money on hand to do those adjustments. And so if you don't have that in your account to begin with, then all the rest of this is kind of moot. And I know a lot of you guys like to keep it close to the wire, play it close to the bone, blasting out as many puts as you possibly can in your account. So this may or may not impact you if that is how you trade. But if you do leave a little bit of room in your account, then you do have a little bit more flexibility than perhaps he implied last week, at least from an OX perspective. Remember, that's going to vary by broker. So whoever your broker is, you have to contact them and ask them for their specifics on how they handle that kind of after-hour stuff. That's how the folks at OX like to handle it. All right, next up, we have a question from a user who goes by the handle Infimy, and he writes, what is the All-Star Panel's favorite options analytics suite? This is an interesting one. We kind of bandied this about a little bit on the show in the past, but we haven't really talked about it in a while, so it might be a good time to bring it up. So I will kick it off, then maybe Mr. Andrew, you can take it. I have a feeling I know where you're going to go, Mr. Andrew. And then Tusaw, if you want to dive in after, you can. I like to use a bunch of different programs, but the one I find myself kind of gravitating to the most, because I kind of just like the interface. Probably some of it is inertia. I've been using it for a long time, so I know how to get most things done in it. And we talked about it before on the show. It is the Live Vol Pro Suite. I think it's a couple $100 a month or so to license this. And what it does is it gives you essentially a lot of the analytics you're going to want when you're out there trading options. So you can pull up your watch list, you can pull up skew, you can pull up historical data, you can pull up time and sales. That's how I like to check a lot of the things we're talking about here on the odd block, see how these things actually went up. You can check open interest. You can do a lot of cool things that we like to do here on the show and just in general when we're running day-to-day stuff over there at Insider, in addition to all the trading I like to do. So I find that tool to be very useful. I know a lot of guys who are still on desks and prop shops too, who also like to have a live vol, at least one screen running there somewhere. It seems to have good penetration with the market maker crowd as well. So that's probably, I would say, my number one go-to one. And that, of course, is in addition to all the different analytics and tools that our various brokerage firms that we work with provide us. We have accounts at a bunch of different firms, including OX, and so I'm in those all on a regular basis. And so they all provide you these days with so many so many great analytics that a lot of you guys probably don't need to go too far to find what you need. You can get your Greeks, you can get your Delta, Gamma, Theta, Vega, even Rho, if you're interested in Rho, and all that fun stuff. You can see skews and charts and graphs and even execute from some of those graphs now on some of these platforms. You can do a lot of cool stuff. We're talking all the time about the trading pattern stuff they have here on OX. We've turned it into a game on the show. So there's a lot of cool stuff you can do with these different brokerage platforms. It's not going to cost you a dime. I mean, you can get access to most of that stuff with just a paper trading account. You don't have to fund anything. So that, if you're looking for analytics, that's probably the easiest and cheapest way to go. If you do want to cough up some money and you're prepared to shell out probably in the neighborhood of a couple of $100 a month, that's where most of these analytics suites go, in that range, then you could do worse than picking up the old Live Vol Pro. Now, Mr. Andrew, I know you have a tool you like to use a lot, particularly for the stuff we do in the odd block, the unusual activity. But maybe you have some other choices as well. I won't put words in your mouth, sir.
I like the live vol. I remember those guys as a market maker. They were getting that company started. They actually traded right next to me in San Francisco. But I do like my 3D product for looking option vision, which I still think it's the best way to look at skew change intraday that there is available on the market. If you're that interested in the detail like that, also I use the volume view for looking for unusual activity, and the realized volatility view for looking at stocks that are moving. So you get a lot of information really, really fast with that product. So full disclosure, I helped invent it and, have a financial interest in it. So if you buy it, it would make me happy. But if you don't, there are lots of good things out there. The OX platform, I got a retirement account in that one. Does some things pretty well. Thinkorswim we use for teaching at Option Pit, and it works pretty well as well, at least until the last upgrade. So it's giving us some fits right now. But I mean, there's probably, there's real expensive ones. I mean, like Valdi Analytics, the old microhedge and things like that. But Live Vol tends to give me, if you're a vol trader, you should have good volatility data. So they provide pretty decent data, I would say.
Yeah, once you're getting into the Valdi, which is the ridiculous new name of the old microhedge, you're talking some pretty serious coin. You got to really want to be, you're managing a prop shop at that point, Yep. But so I don't think of course, they keep telling me over there that they're going to come out with a scaled down version for retail that would hopefully be at some reduced price point. I keep waiting for that. They've been telling me that for about 5 years. So I've kind of given up hope of waiting for that. But theoretically, that could be in the works some way down the road, and that would be an interesting choice as well, because everyone who's been around the business for a while knows microhedge, at least. It's a very storied name in the options analytics space. All right, good question, Mr. Infimy. Next up, we have, I guess, more of a comment than a question. This is from user goes by the handle Hack3, and he writes, Bitcoin imploded after you guys trashed it on options block. Coincidence? I'm going to say no, sir, Mr. Hack3. That was clearly us slamming Bitcoin. And then, of course, if you remember listening a couple weeks ago, we had someone write in asking us about, I believe it was derivatives on Bitcoin, when they would happen, that sort of thing. And we all proceeded to kind of slam it as kind of a crypto money laundering currency. And then sure enough, I believe it might have even been the next day is when that exchange started denying withdrawals, which is never a good sign. And so the currency really took it on the chin. I think it was down, 20-odd%, if not more. So, Bitcoin not exactly looking that great of late. And it primarily was because Andrew and I really took it to task here on the program. Wouldn't you agree, Andrew?
I think so. I think it wasn't that we were just lucky. We were good. We we knew it was going to fall apart.
The real reason is when you guys said it was going to fall apart, I took all my money out right away.
And that was it.
That's what drove it down.
I knew you were a cryptocurrency guy. You always had that whiff of money laundering about you, sir. Now I see I was right all along. All right. And last up here, we have a question from a regular listener here of the Option Block, Mr. John King. And he writes, could you discuss the preference of the ironfly to regular butterflies? Iron condors, etc., always neutral or okay with one side in the money. Timing, thanks. And I believe what he's referring to here is my oft-stated preference on this show for the iron fly versus the traditional fly, and even for the traditional iron condor. Like I've said on the show before in the past, there's a refrain, I believe it came from our Volview show. The iron condor is an iron fly for cowards. I kind of like that expression. And it's not, I don't wholeheartedly agree with it, but it does kind of summarize one of the reasons why I like the iron fly over, let's say, an iron condor, is that if I am going to do this is a position that I'm probably going to keep an eye on more. And I want to have a little bit more bang for my buck in that sense. And so I probably will gravitate towards, particularly on the short side, if I'm going to short that premium. The iron fly, you can set it all up with 3 legs. It's pretty easy. But I still like it, particularly on the short side, I'll go iron fly, and then I'll lock it in much tighter with a pretty tight wings around it, and that's the way I'll go. Sometimes if I'm not going to be able to watch it a little bit more, or if I need a little bit more wiggle room because I'm just not that sure and I have other stuff going on, I might switch to an iron condor because it does give you a little bit more of that flexibility, which is why a lot of people are really liking it, particularly if you're going to go on some of the long side. It's also a little bit lower outlay, which is attractive to a lot of people. So I might go that if I'm going to go long premium, and I'm a little uncertain about how I'm going to be able to manage it minute to minute. So I might go that route instead. But typically, I will lean pretty much neutral. That's kind of the way I like to go. I like at the money, go big or go home. I will do one side in the money every now and then, but I don't lean towards in the money call iron flies or anything like that. I really tend to do the more of the straight up around the at the money type of neutral iron fly. Typically I do these are mostly event driven, so I'll do them front month. Once in a while I'll leg into some funky iron time flies where I'll have maybe the guts in the front month around the whatever event it may be. Could be an earnings announcement, something like that. And then depending on how the term structure looks, I will leap the wings out a month or so, or depending on where the best place is to hedge those wings. And sometimes if you take advantage of that, you can take advantage of the really, really juicy premium in that earnings month and then buy some really cheap protection 1 month out. And then you have a really nice time iron fly. That's actually kind of the way I tend to be going more often these days, is kind of that time fly where I put the guts in the front month and then, or whatever front week, whatever it is I'm trading there, and then I roll out a little bit for the wings. And depending how you set it up, you can do those for you sometimes even fairly attractive levels. You guys, any preference here on the iron flies versus others?
Yeah, I like the analogy of how the condor is an iron butterfly for cowards. I haven't heard that's a good one.
I think that comes from Don Schlesinger, our former co-host there on Vol Views. Sounds like him, doesn't it?
From him.
Yes, it does sound like him.
That's pretty good. I typically, when you're selling premium far out of the money, you got to be careful when doing that, just because it works good until it doesn't. And I'm not against iron condors. In this market, I'm very much against iron condors, although I am going to have a webinar on them next week just to kind of talk about them. But when the market stays still or stays the same, there's no better place to be than at the money. It's unless you have some type of weird skew going. If God were to tell me the market's going to stay the exact same between today and 3 weeks from today, never move, then I'm going to be selling a naked short straddle. Now, unfortunately, God doesn't give me trade tips, but my point is that if you're going to be neutral, then you might as well be neutral. So, yes, I want to have a little bit of wiggle room, but you need to have a plan for how you're going to adjust that in case something happens. So for example, I was in a trade yesterday, or 2 days ago actually, on the Russell, and the market, if it were to go down, I would have simply, the Russell was at 1160 and I was in an 1150, 1130 diagonal put spread, short the 1150s for next week. And my plan was to just roll it down. Now, I eventually got out of it beforehand, but my point is that I had premium very close to being at the money. That's where my short premium was, and we benefited from it. So if you're going to sell premium, most of the time, my preference is to sell something a little bit closer to being at the money and just have the adjustment plan ready in case something happens.
All right, 2 votes for the iron fly. Mr. G, where do you fall in the great iron fly, iron condor debate?
Mike was right. And what I think to make it simple is, to answer his question, you have to have a reasonable expectation of realized volatility to pick the proper type of trade. So, by definition, Mike's saying, well, I think, we're not going to move around very much. I want to sell gamma at the money. If I want to be more aggressive with longer term Vega, maybe you go to an iron condor or something because you're selling more Vega intensive option and you're looking at less more toward the gamma. So like one of the key parts is one is risk control for the trade, but you have to have an idea of, how much the underlying is really going to move, because that ultimately is your deciding factor if you want to just trade sort of on a delta neutral basis. If you have, I would say, like a bias for the underlying move and there's some skew, kind of a standard fly, depending on, if you want to be long or short the trade. So what you have to kind of do is you have to think really what's going on with the realized vol and where volatility is, and that's going to help you sort of create the shape of your trade. And once you do that, you kind of figure that out, then you create the trade shape. It's not, so what we think about it as, it's not Monday, it's my iron fly day. It's more like, okay, well, this is what the market's doing. Is a fly better to take advantage of this to generate the gain from a drop in volatility, or is the iron condor the better type trade? So try to do is figure out what the condition is and then fit the proper trade to the condition. And I'll just say, we do have some free webinar stuff on butterflies and things like that that might be helpful for this. Go to optionpit.com. You got to sign in. You got to give us your email address so we can send you something every month. But we do have some free webinars on this type of topic.
I'm going to hold your feet to the fire, so you can't just give the politician's answer of the strategy must fit the scenario. Of course, that is the overarching rule, but looking back on your own trading patterns, would you say you tend to favor one versus the other?
Yeah, probably more iron butterflies.
There we have it, sir. 3 votes for the iron. I knew I can get an answer out of you eventually.
Well, I want to add something to this. When you are using an when you are selling premium at the money, Andrew said something that I just want to kind of add upon, is having realistic expectations. And just to give you an idea of it, Mike Cavanaugh and I talked once in terms of how many times have we actually seen a butterfly expire right at the money and had someone in it, even seen it, whether it's us, a client, or anything. And between us, we have, close to 30 years of trading experience, and we've seen it twice between the two of us, and both times were him. So, and I'm not talking about it happened to us. I'm talking about we actually saw it happen. So there's people that bet on the Broncos in the Super Bowl, and there's people that bet on the Seahawks in the Super Bowl, but very few people bet that there's going to be a tie. So in football, ties do happen at times, but they're very rare. They never happen in the Super Bowl because obviously they just keep playing overtime. But in the regular season, ties do happen at times, but they're extremely rare. When you trade an iron butterfly, you're betting on a tie. So what you need to do is understand what your, as a wise man once put it, realistic expectation of when you want to take the profit at an earlier time is going to be, and have a plan for it.
I also had the over-under on how soon it would take you to work a football analogy into the show. And we got pretty close. You're actually past the 1 hour mark, so I would have lost that bet. I would have bet earlier.
It's just so sad you just can't take the football out of him. I have to send him a nasty Skype message about, what's that game again? Football? What is that game?
I'm running the blitz on you guys then.
All right, great questions. One and all who wrote in. If you'd like to join your fellow listeners, a lot of great ways to do it. Of course, shoot us an email, questions@theoptionsinsider.com. Post a comment on the show notes there on the old website, theoptionsinsider.com. Find us on social media, twitter.com/options, facebook.com/theoptionsinsider, or, of course, find us through the new Options Insider Radio Network mobile app. And before we go, let me check in with each of my cohorts, my partners in crime, to see what they have cooking in their respective necks of the woods that may interest you, the listener. Starting off with you, Mr. Giovanazzi. What is coming up in the land of the pit? I hear you might have a few webinars cooking.
We do. You know what? It's going to shock you. I'm actually prepared.
Who is this person? What have you done with him?
I know. It's a strange clone. The 8th of March, we will be giving a webinar on how to sell puts in an ugly market. And I think maybe even Mike Tusaw would agree. The best time to sell puts is when nobody wants a stock that you want. So, and that's why I brought up kind of the QQQ analogy. even when you want to add things to, let's say, a retirement account, you want equity exposure, stocks of high quality that are just getting pounded, and you want to buy them below the market, that's the best way to trade a put. Selling puts every week on Amazon, I think that's a much tougher trade. So we'll just try to work on, ways to use a short put to your advantage, and also some protection techniques as well, so you can get in, but keep the risk of the getting in at a relatively low level.
Thank you for that, Mr. G. Mr. T, what is cooking in the land of RCM?
Well, we're excited. On the 27th, we're going to have a webinar on the Iron Condor. And then after that, on the 4th of March, we're going to have a special Tuesday edition of Thursday Night Trading. Mr. Mark Sebastian is going to be talking to us about the dangers of the credit spread. So we're excited.
Oh, don't get him started on credit spreads and how they don't exist. He'll fill a whole hour with that talk. Are you going to follow up the Iron Condor webinar with a webinar on how you prefer the Iron Fly?
I think I should now.
now that we've all come out clearly on one side, despite Andrew's mealy-mouthed attempts, you should have a follow-up webinar saying, "Here's what I really like."
Mealy-mouthed attempts. I take umbrage to that, sir. Umbrage.
All right, before any more umbrage can be taken, I should close out this episode of the Option Block. So on behalf of Andrew and Uncle Mike, and of course myself, let me thank all of you out there in the listening audience for downloading and streaming and subscribing to this program, and of course for writing on such great questions. Keep them up, and we'll see you next time right here on the Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting, and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.